Chapter 7: Factors of Price Growth. The inescapable fact is that the value of an asset, whatever its character, cannot over the long term grow faster than its earnings do. Warren Buffett. In the short term, stock prices can be erratic, but generally, stock prices tend to grow in the long run. Over a very long period, the S&P 500 has climbed by almost 10% annually. There are three primary factors of growth in stock prices. 1. Earning yield, yield factor. 2. Inflation, inflation factor. 3. The expectation of earnings growth in the future, hope factor. Yield factor. The value of a stock should theoretically increase by the amount of its yield. For example, you buy a stock for $100 and it's currently earning $5 per year. Suppose there is no expectation of growth for the foreseeable future, but the company can realize its assets at book value at any time. You bought the stock at precisely 100% of its book value on January 1st. During the year, the company earned $5 and its book value is now $105. If everything else remains unchanged, then the price of the stock should be exactly $105. Buying a stock at a reasonable yield is extremely important. At least the company will keep earning at the current rate if there is no growth, and in the long term, your stock prices will go up by the amount of earned income. Inflation factor. All monetary assets, like cash or bonds, are exposed to inflation risk. For example, if you buy a bond earning 5% and inflation is 2%, your real gain will only be 3% because inflation will erase 2% of your buying power per year. Stocks are generally immune to this inflation degradation. Technically, in stocks, inflation is embedded into overall earnings growth assumptions, but I prefer to separate it from organic growth. It is much easier to understand inflation's impact on stock prices if you keep it as a separate factor. Suppose a company sells 100 units of its product per year at a net profit of $1,000 each. It means the company's annual earnings are $100,000. If the annual inflation rate is 2%, then next year's company earnings should be $102,000, everything else being equal. You can call it earning growth, but it is better to keep inflation separate from organic growth. Growth factor. The third and most crucial factor of long-term price increase is the organic growth of its earnings. Growth is the only factor that is subject to significant assumptions and can substantially differ from the estimate. The profits of a company may go up or down, and it will affect its prices. When you buy a stock on a P/E ratio higher than the market, you are essentially saying to yourself that your stock will outperform. Earning growth of that particular stock should be faster than the overall market. If this is not the case, you should be better off just buying a broad market index fund. Suppose the S&P 500 P/E ratio is 20, which means the yield is 5%. If you are purchasing a stock at a P/E of 40, your yield will be 2.5%. If you are willing to accept a lower yield at the time of stock purchase, you should be hoping that earnings will be growing much faster than the overall market. This expectation of outperformance is the reason I call this factor the hope factor. S&P 500 historical growth. At the very start of the first chapter, we studied a long-term chart of the S&P 500. There were periods of rapid growth and periods of bear markets. There were periods where the price didn't go anywhere for years. However, the S&P 500 grew by about 9.5% annually over a century-long period. Let's write factors of price growth in a simple formula. Annual price growth equals yield plus inflation plus organic growth. If we assume that the P/E ratio was 20 during that time and earning yield was about 5%, it means the remaining 4.5% came from inflation and organic growth of the companies. If inflation was 2%, then the rest is organic growth over a long period. During that time, GDP growth was about 2.5% more or less, including inflation of 2%. So the US economy's organic growth was only 0.5%. We can safely assume that S&P 500 companies were growing faster than the rest of the economy. So here are components of 9.5% total price growth. 1. 5% earning yield. 2. 2% inflation growth. 3. 2.5% organic growth. We can fine-tune these numbers. For example, historical PE is closer to 18 than 20, and inflation could be 2.25% rather than 2%, but we stick to rough numbers for ease of calculation. The concept is more important than historical accuracy. Buying stocks. To my mind, the so-called growth stock investor, or the average security analyst for that matter, has no idea of how much to pay for a growth stock, how many stocks to buy to obtain the desired return, or how their prices will behave. Benjamin Graham. When we buy stocks, we have a vague idea about the earnings growth. But if we are asked to quantify this growth expectation in numbers, we will struggle. If you are picking a stock, you are essentially making a statement that this stock will be performing better than the overall market. Try to justify the purchase by comparing one share to another. Can you say that a 100 PE stock is better than a 10 PE stock if you decide to buy one? We can calculate expected organic growth with a modification of the formula mentioned earlier. Let's try to understand with an example. Suppose you buy a 100 PE stock. It means your yield is 1%. Assume inflation is 2%. S&P 500 PE is 20 and the yield is 5%. You accept a lower yield because you are expecting a 15% annual price appreciation instead of 9.5%. Organic growth factor equals price expectation minus earning yield minus inflation. 12% equals 15% minus 1% minus 2%. It means that your stock earnings should be growing at least 12% organically. If it grows less than 12%, then long-term price growth will be less than 15%. If organic growth remains better than 12%, then you can expect a better price appreciation. Day-to-day prices in the market will always be erratic, and there will always be market noises. The market will go up and go down, but these three factors will prevail on a long-term basis. There is nothing wrong with buying a high PE or negative PE stock, as long as you can justify accepting a lower present yield with a higher future growth. Always remember that it is not a calculated risk if you haven't calculated it. To calculate your expected organic growth, you need to fully understand all the revenue streams, costs, and many other factors. All high growers slow down over time. Fast-growing companies can't be expected to keep up the pace forever. Eventually, they reach middle age and lose some of their oomph, just like the rest of us. Peter Lynch. You can always find stocks growing by a 50% plus rate annually, but remember, this rate will not last forever. For example, Facebook was growing its US users by this rate in its initial years, but eventually they hit the roof. The total population of the US. They cannot grow in the US in terms of users more than the entire US population, no matter what they do. It is called the total addressable market. Companies with high growth rates can hit their total addressable market within a few years. When you buy a high PE stock with a high growth rate, try to calculate that in how many years this company will hit a market growth rate. At this time, we can expect a PE closer to the overall market. Why calculate the growth factor? People who chase growth, who chase high flyers, inevitably lose because they paid a premium price. They lose to the people who have more patience and more discipline. Seth Klarman. High PE means higher hopes and higher risks. If the hopes and risks are higher than the market, then the reward should be higher. High PE demands outperforming the market. Calculating organic growth for a stock is not easy. You can write many positive and negative points in words, but translating these bull and bear cases into numbers may not be straightforward. An individual investor can do it for a certain number of stocks, but doing it for hundreds of shares will not be possible. You should not expect to analyze all 500 stocks of the S&P 500 and successfully pick winners. you probably need to filter out a lot of shares before even starting any research. Yield and inflation factors of total price growth are either calculatable or remain very close to historical averages, but the growth factor is unknown. You can estimate it, but can never be sure. You hope that future growth is either better or at least on par with your expectations. Advantages of calculating the growth factor. 1. Provides a measuring stick. 2. Comparison between different stocks is easier. 3. Forces you to put your expectation in the form of numerical values. 4. Takes out subjectivity. 5. It keeps you on track. 6. Easier to avoid overvalued stocks. 7. Easier to buy undervalued stocks. 8. Avoiding FOMO. 9. Detaches you from price action and forces you to focus on business. 10. It forces you to think long term. 11. Easier to avoid impulse buying and selling. Provides a measuring stick. The ability to measure is so fundamental that we cannot imagine our world without measuring tools. You don't bake a cake without measuring flour and other ingredients, so why buy risk assets without it? Sure, you can eyeball quantities of ingredients, but your baking results will not be desired each time. When you buy a stock, you should know the expected growth that this particular stock is offering. It is not enough to say that the industry is growing, and my share will grow with it. It is your hard-earned money that is at risk, so you had better calculate it. Once you have calculated your required growth rate, then you can do all the research in the world to come up with an expected growth rate of that particular stock. If your expected growth rate is higher than the required growth rate, you can buy the stock. If not, just pass and move to the next one. Comparison between stocks is easier. Losing money is not the only risk in the business of investing. Subpar return is another risk that you need to consider. When you are about to deploy your capital, a world of possible investments is in front of you. You need to allocate your money to the highest return possible. Without a measuring tool, how would you do it? To compare different stocks with each other, you need a common yardstick. When you decide to accept a higher trailing PE than the overall market, you expect higher returns. A 40 PE stock should offer better returns in the future than a 30 PE stock. But how much? Calculating the required growth rate provides you the amount of additional growth that a 40 PE stock should offer. It forces you to put your expectations in numbers. When we read an analyst report for a stock, we find several positive and negative statements about future growth. Most of the time, these statements are subjective without any numbers. For example, ABC Company acquired XYZ Company last year, and we are expecting a positive impact of this merger on the net income through synergies. You see, this whole statement is without any numerical context. How much would the positive impact be? 1%? 10%? Or 1,000%? You don't know. However, once you have calculated your required growth rate, you are forced to put your expected growth in the form of numerical values. You will need to translate all these positive and negative statements into real numbers. This exercise will provide you a real insight into the company's affairs. Takes out subjectivity. Using a numerical model takes out subjectivity from the conversation. Instead of saying that this company will do exceptionally well in the future, you will be saying, I expect a 20% growth in earnings for the next 10 years on average. There is no ambiguity or vagueness in your statement. When your expectations are in numerical values, you can compare them with actual results and take corrective actions if required. It keeps you on track. When you put your expectations in numbers, it helps you avoid hyped investments and protects you from selling your profitable holdings just because people are talking bad about it. You calculate your expectations and compare them with business performance, not with daily price action. Remember, when the market goes down, people are selling their dollars for dimes, and when the market goes up, people are paying dollars for dimes. You don't want to be among those people. Easier to avoid overvalued stocks. It is much easier to avoid hype stocks if you use some analysis for future growth and put a number on your expectations. We all know that artificial intelligence will change the world in the future, or quantum computing will increase machine computing power by 1 million folds. But investing your capital into these companies should be a business decision based on these businesses' earning capacities. Look at the examples of 3D printing and renewable energy companies. Let's take another example. In the 90s, everybody knew that the internet was going to change the world. It was not a secret. Ask yourself, should you have been buying internet stocks in the late 90s or 2003? Hindsight is always 20/20. It is easier to say it now, but in the late 90s, how do you protect yourself from fear of missing out? If you always put a number on future growth expectations, you can easily avoid the crowd's madness. When you buy a stock with hundreds of PE, you should know that you expect exceptional earnings growth for years to come. If your company fails to deliver those sorts of growth, stock prices will go down like a rock. In a blink of an eye, the stock will be discounted to 50, 60, or 70%. You will not have any time to react. When a share goes down 50% from your purchase price, it needs 100% price appreciation to reach your break-even point. It is always better to avoid hype stocks and desire to double your money in no time. Easier to invest in undervalued stocks. Occasionally, the stock market goes down dramatically and creates a short window of opportunity to buy stocks at deep discounts. However, to act upon it, you need to be prepared before it happens. If you have passed a share in the past because the price was too high in relation to its growth prospects, now it is available at your desired price or even cheaper. Why shouldn't you act on it? If you are well prepared and have done your homework beforehand, it would be psychologically comfortable to buy the stock. There is one crucial thing to consider. You should not be buying stocks because prices have come down. You should only be buying when prices are significantly lower than companies' expected growth rate. If 200 PE stock has lost 50% of its price, it is still expensive. Price action should not be a trigger point. What matters is the future growth of earnings. Avoiding fear of missing out, FOMO. FOMO is real. It affects me, you, and every investor of money alike. I am sure it affects Warren Buffett as well, but he has mastered how to deal with it. Let me ask you to do a little exercise. Pick any 10 stocks that you want to buy and think that if you don't act now, the share may run away from you and you will never catch it. Write down the current price and wait a couple of years. At least 8 out of 10 stocks will go far below the price you have written down. I've tried it many times and it always works. The best way to avoid FOMO is to refrain from impulse buying. Calculate the expected growth in earnings for the foreseeable future. Determine an acceptable PE and a price. Wait for the price to come to your desired level and then buy it. If it goes down further, buy more. Detaches you from price action and forces you to focus on business aspects. You must detach yourself from the daily price or minute-by-minute price action of your stocks. It doesn't matter. Looking at your screen all day long cannot affect the prices. Put price action in its place. It is only the last transaction price that one out of millions of shareholders has agreed to sell its share to another person. That's it. You don't need to agree with the seller. Even the buyer doesn't agree with the seller. In the buyer's mind, the stock should go up. That's why he or she is buying. There are millions of other people who disagree with this price. It is vital to keep your focus on the business side of the stock. A stock represents a proportionate share in the business. Instead of wasting your time by looking at the screen all day long, you should learn more and more about business, advantages, weaknesses, threats, competition, etc. It will serve you better. When you force yourself to calculate an expected growth rate of a business, all of your buying and selling decisions are born from that analysis. This exercise detaches you from daily price action and lets you focus on the business of the company. It forces you to think long-term. An analysis of business growth forces you to think long-term because it doesn't change every day or every minute. It takes a long time for a business to change its course. A long-term trend does not change in a week or a couple of quarters. Let me suggest an exercise that I have done many times to calm my nerves. Go to any website that can show you the live price action. Put a minute chart where each bar represents the price action of a minute. Keep watching your favorite stock all day for a week. Write down how many times you wanted to buy or wanted to sell. Next week, put a monthly chart when one bar represents 1 month of the same stock and watch it all day long for a week. Then write down each time you want to buy or sell. 1-minute charts boils your blood. Every few minutes, you either want to buy or want to sell. You feel like you are missing a massive opportunity by not acting upon price action. When you switch to the monthly chart next week, all this price action looks like nothing. You will not even notice any change unless you are doing this exercise in the middle of a significant downturn. Short-term price action means nothing and should mean nothing to you. Keep your focus on long-term business growth. Easier to avoid impulse buying and selling. It happens to me, and I am sure it happens to you too. Buying or selling a stock without any previous plans and just looking at the screen and price action. There is somebody inside who urges us to act, do something, so we buy or sell. We all know that this is impulse action, and that we should not be doing this, but we still do it and later kick ourselves. Sometimes it can be right, but more often it turns out to be a wrong decision. Following a system and pre-calculating buying or selling prices forces you not to take impulse actions. However, you should not follow a system based on price action. Your focus should always be the fundamentals of the business and a calculated price based on those fundamentals. Buy not on optimism, but on arithmetic. Benjamin Graham. Chapter takeaways. Long-term price growth has 3 factors: yield, inflation, and business growth. Nothing wrong with buying high PE stocks. However, expected business growth must justify the high price. Calculating expected business growth provides an objective measure to compare different companies.